Good morning, everyone. Again, thank you for joining us today. I am Laura Labanier, your CalTrust Chief Executive Officer, and today we have our annual Coffee with CalTrust webinar. This is a webinar that we like to do once a year and invite everyone, all our shareholders, existing, potential, other public agencies in California, anybody who's interested in learning about CalTrust to join us and kind of get the CalTrust 101, so the who and what we are, and then also dive into a market update and kind of some more direct information on how our funds are positioned. So joining me today, we have two wonderful guests. We have Will Goldthwait. He is portfolio strategist with State Street Global Advisors, and Simona Makuta, who is the chief economist with State Street Global Advisors. I think everyone's going to really enjoy getting to hear from Will and Simona later. And as most of you know, State Street Global Advisors is our asset management team here at CalTrust. So they are the firm that actually manages all the investments on our behalf and our funds. We would love for this to be interactive, so please use the Q&A chat box. Use the Q&A box, use the chat box, ask us questions, and make this interactive as we go along. So without further ado, I'm going to go ahead and launch into the basic 101 of CalTrust. The slides that I show today, we are going to make these available to everyone after the presentation. So don't worry about trying to note things down. All of this will be sent to you. So you will have this available to you. So the basic, what is CalTrust? Who and what is a CalTrust? So CalTrust is a local government investment pool. We are a public agency ourselves, having been formed as a joint powers authority. We were formed in the early 2000s by two counties and a special district who are actually looking for an alternative to the state's pool. The state at the time had a cap of 40 million on LAIF. It is higher now, but there is still a cap. And they had more restrictions, and there wasn't many options in the state for smaller agencies to diversify, or even for the larger agencies to diversify their investments. So that is how CalTrust was formed, was the brainchild of Sonoma County, Solano County, and Westlands Water District. Because we are a public agency ourselves, we are only open to California public agencies, and our investment policy mirrors California Investment Code. As I mentioned, CalTrust assets are exclusively managed by State Street Global Advisors. So this is just the section of code. California Government Code 53601P is what explicitly allows for public agencies in California to use JPA LGIPs. So if you want to use a CalTrust or JPA LGIP, you would want to just make sure that your investment policy allows for this section of code, because oftentimes we do see public agencies have more restrictive policies. Again, this is just some more information on that code, and you will receive this. So as I mentioned, this was our history. We needed options in California. One key thing is that in 2003, CalTrust was initially launched to our first shareholders, but it wasn't open widely yet. The CalTrust trustees at the time decided that they wanted to have some more clarifying legislation put into place to make it easier for public agencies to know that they could participate and to participate in JPA LGIPs. So even though we were launched in 2003, we took some time to actually work and have some legislation put in place that clarified the use of JPA LGIPs such as CalTrust, as well as clarifying that public agencies do not need to become a member of the JPA to use the funds. And so then we were fully launched in 2005 to other public agencies in California. The objectives behind CalTrust were transparency, flexibility, ease of use, and unlimited transactions. So our leadership is mirrored today in how we were at our launch. So CalTrust is governed by a board of trustees comprised of public agency treasurers and investment professionals. So anyone who serves on our board of trustees is actually a practitioner in the investment space with a public agency. Myself, I was hired in 2019 as the first full-time chief executive officer, but I've been working with CalTrust since 2008 when I managed them on contract with the previous agency. So personally, I've been involved with CalTrust for 16 years now, and it's been my delight to see the program grow from, I believe I remember celebrating $500 million in assets when I joined to almost hitting $5 billion this year. In 2021, we continued to expand our staff, and we hired 2 additional full-time staff. Our outreach and relationship manager, Todd Winslow, and our executive and shareholder services assistant, Nicole Zajic, who many of you have worked with. And then we added James Wilfong to our team last year. One note about CalTrust is our administration and leadership is fully independent to the JPA. So myself and our team, we are actually JPA staff. We are CalTrust staff members. We're independently managed. So even though we have State Street who manages our investments and other third parties that we work with, our administration and leadership is fully independent, and we are not tied to any of those. Here is our board of trustees. So you can see that currently our treasurer is from the city of our president is the treasurer from the city of Sacramento, John Colville. And then we have multiple special districts, counties, and cities represented on our board. Here are our service providers. As we've been mentioning, State Street is our investment management team, but we also use US Bank for our custody services and Ultimus Fund Solutions for our fund accounting and our transfer agency. One important thing that we take very seriously at CalTrust is that we regularly RFP for all of our service providers. Our policy at CalTrust is that we never go more than 7 years without issuing an RFP for a service provider. Our typical timeline is more around 5 years, but we also have, excuse me, my allergies are so bad today. We have also issued RFPs earlier in the past when we felt that there was a gap or a room for improvement with one of our service providers. So we do take our process of issuing RFPs very seriously. We are not afraid to make changes if changes need to be made. We've seen that over the years, and it is something that we do regularly. So this year, for example, we'll be RFPing our audit service provider, who is not listed. It has been Brown Armstrong the last couple of years, but we are moving into an RFP for that provider right now. So some of the key features about CalTrust: we are, as I mentioned, compliant with Government Code 53601. So anything that we invest in, you can invest in. We have 3 different fund options: our liquidity fund, which is our stable net asset value fund, and then our floating NAV short and medium term funds. And we'll get into some more information on those in a couple minutes. We have no minimum or maximum investment amounts. So you can have as little or as much invested in our funds as you'd like. We have shareholders with anywhere between $300,000 and $300+ million invested in our funds, and all of those shareholders get the same benefits, the same treatment, and are just as welcome. So there are no minimum or maximum investment amounts. And that also means that if there's ever a point where you need to draw your fund down to 0, you can do that, and that's not a problem. So that is definitely something that a lot of our shareholders really appreciate. We have no minimum or maximum transaction allowances, so you can transact as often or as little as you would like. We have no extra transaction wire or account maintenance fees. All of our fees come off of the overall earnings on the fund, so there are no direct costs coming directly from you for account maintenance. Excuse me. We are fully transparent, so you can log into our shareholder portal 24/7, and at any point you can see daily updated list of all of our holdings for each of the funds as a shareholder. You can have unlimited sub-accounts, which a lot of our shareholders take advantage of. You have access to investment expertise. As you'll hear from later today, we have some of the best in the business that we're able to work with, and they are available to our shareholders as well. Our online portal is not only available 24/7, but it is customizable to your access levels. So when you set up an account with CalTrust, you tell us who your authorized signers are, how many people are required to sign off on a transaction, and what level of access you'd like. So we often have shareholders who have staff who just has view-only access, or even their auditors who have just view-only access to their portal. And you can also enter transactions 24/7 anytime. Our statements come out the first business day following month end, with additional reporting the fifth business day. We do accrue and pay out our interest monthly. So you do get a monthly earnings of your interest. Our default is to auto reinvest, but we can definitely work with agencies who have their earnings wired to them every month. And as I mentioned, you do not have to join the JPA to participate in CalTrust. So who can participate in CalTrust? It is dictated in California government code who is able to invest with us. And it is basically any public agency in California and then some. So cities, counties, special districts, joint powers authorities, federally recognized Indian tribes, transportation commissions. The list is pretty extensive as far as any public agency in California. Currently, CalTrust has around $4.5 billion in assets, and it's very evenly, not evenly, but it's very well diversified between different shareholder types. So counties currently make up our largest shareholder base with roughly 1.2 billion of our assets, with cities coming in at the next highest at 992 million, or 22% of our assets, and then local health plans, special districts, and JPAs each having about 17% of that pie right now. So we are very well diversified across different shareholder bases. And one great thing about CalTrust is because we are for all public agencies, and all public agencies follow the same code, we are able to really help everyone despite what type of public agency you are with your investments. This is how our assets are currently split out by fund. So as I mentioned, and I'll get into the details in just a second, we have 3 funds. Our liquidity fund, which is our stable NAV fund, is sitting just under 2 billion as of March 1st. Our short-term fund is 1.2 and our medium-term fund at 1.4. So a little bit on the funds themselves. The liquidity fund is our stable net asset value fund that has same day liquidity. What's nice about this fund is we actually have 3 cutoff times within the day. We have a 9 a.m., an 11:15 a.m., and a 12 p.m. cutoff time. What's great about that is that if you get a transaction in earlier in the day, then you get your money wired out to you earlier in the day. I believe we also do have the latest cutoff time of any of the LGIPs in the state currently, and we've definitely bailed people out who have an 11:30 a.m. need for cash. So it's great to have that extra hour, extra 2 hours available to you. That is an S&P rated fund. It is rated AAA. We also then have our short-term fund, which has a next day liquidity. It's a floating NAV fund. So this is really your like 0 to 1 year fund. So this is where you might want to look at for money that you don't need right away, but you want to have pretty liquid. It is a floating net asset value fund. It is rated AAF from S&P. And then our longest term fund we have currently available is our medium term fund, which is like your 1 to 3. It is also next day liquidity, which is nice. So even though it's a longer term fund, you still have access to your money at any point in time if you need it. Again, it has a 10:30 a.m. cutoff time, and it is a AA-F fund. So those are the basics, and we'll talk more about each of these funds later on. So just to recap, I'm not going to rehash everything because I've been talking at everyone for a while now, but we do have, all these wonderful features available to you. Getting started with CalTrust is pretty simple. We have a simple participation agreement form where you give us all your agency information, your banking information, your authorized signers, the authorization to create the account, all that fun technical stuff. And then within 2 business days, we have your account set up. Normally it is less. And then you are able to initiate transactions in your online trading system or paper form, and you have our whole team available to you. And as I mentioned before, what's great about the fact that our team are all CalTrust staff and dedicated to CalTrust is that you get folks that you're going to get to work with us directly anytime you need assistance. So you'll get to know our team and we'll always be there for you. And I get phone calls myself and I'm always happy to help people myself. So we have just some information that will be provided to you here on the funds themselves. But I have been talking at you for quite a while now, and I am losing my voice temporarily. So I am going to stop talking at you and see what kind of questions I can answer. There are a few questions. Someone did tell me that I accidentally have the chat box disabled. My apologies. I'll fix that in a minute, but the Q&A box is working if you have questions. Um, so some of the questions we have come up, what does it mean by having sub-accounts? That's a great question. So you can have multiple accounts for your agency, and we have agencies that have up to 20 accounts. So if you want an account for specific reserves or specific bond proceeds, you can have any number of sub-accounts established under your agency. So you would have your main agency account. So let's say you were City of Sacramento, you would have your City of Sacramento account, but then you could have City of Sacramento for this project, for these reserves, for this amount. So it's just a way for you to get to organize your money, much like you would personally if you had sub-accounts for yourself at your bank for different savings accounts or for your children or that kind of thing. I'm happy if you want to reach out to have more discussion on that. And then we have a question about how do our yields compare. So our yields are available always on our public facing side of our website as well as in our portal. So on a day-to-day basis, if you are shopping yields, you can always log into caltrust.org and go and see what our yields are for those days. And oh, here's another one. Great question. Do agencies decide the fund options the money invested in, or is this at CalTrust discretion? So between the three funds that we offer, our liquidity, short and medium term fund, you decide where you want your money to go. So it is up to the agency to decide which of those three funds you want to invest your money in. And then it is up to State Street and CalTrust to then invest for those funds as a whole. So you would say, I want all my money in this fund. I want to split between this fund, and that choice is yours. You also, one cool thing is with our portal, it makes it really easy to transfer money between funds. So right now we have people, lately I've seen some folks transfer money from the liquidity fund to the short-term fund as they're getting more comfortable with kind of the normalizing curve and wanting to start going a little further out. So it is also easy for you to transfer money between accounts. As far as fees for withdrawing cash immediately, there are no fees on our end for your withdrawals or contributions. There may be fees from your bank. So your bank may charge you a fee when you wire money to us for a purchase. They may charge you a fee when you receive money as a wire, but there are no fees. The only limitations you'll be working within are our actual cutoff times. So as if you need your cash immediately, if you're in a liquidity fund, as long as you put your redemption in by noon Pacific time, you will receive the money that day. Otherwise, it will be the next day. And with the short and medium term fund, that's a 10:30 a.m. cutoff time. So as long as you have your transaction in by 10:30 a.m., then you would receive your money that same day, or after 10:30 a.m., it would be the next day. So there are no additional fees. Any other quick questions there I can answer? And then insurance. Okay, great question. So we are not a bank. We get this question a lot. So we do not have like FDIC insurance on our funds since we are an investment fund and not a banking institution. So you have the same type of risk you do with any type of investment. All right. That looks like all that has come in for at this point. Please, folks, go ahead and continue. We'll come back to Q&A and make sure we get to everything by the end of the day, or we'll reach out to folks if we don't get to you. At this point now, I am going to turn it over to Will to continue our conversation and get into the interesting stuff with Simone on what is going on in our world today. And while they are talking, I'm going to try to remember how to engage the chat box again. So, Will, it's
That's awesome.
it on
That,
over.
that's great. Thanks, Laura. Great to be here. So I do have to say a little disclaimer that Simona and my views are our own. They are not the views of State Street, and that what we talk about today is simply our opinion. It should not constitute investment advice and should not be relied on as such. So I apologize that I have to say that, but my compliance folks are my compliance folks, so I have to be a good employee. Okay, so great overview of CalTrust and the products. I think what we're hoping to do now, I'm just going to ask Simone a couple questions, and then I'll ultimately try to translate sort of her view on the economy and how she's seeing the prospects for growth, inflation, jobs. I'll try to translate that into how we're positioning the three different portfolios. So Simona, let's start with the Fed meeting yesterday. I know you put out a blog piece, you put out a short video on LinkedIn. I have sent a Q&A response that's gone out to all the CalTrust folks. Sort of what are your key takeaways from the meeting yesterday, from the press conference with Chair Powell? Sort of how has this changed any of your views based on yesterday's meeting?
Definitely not based on yesterday's meeting. And I think honestly, the biggest takeaway from the whole, conversation, the press conference, even the lack of movement, you know, larger movements in the dots is everybody's awaiting for clarity, and I think we'll still be awaiting for some time because there's a lot of noise. But this idea of, trying to separate the noise from the signal, trying to separate the goal of a policy from the tactics deployed in the achievement of that policy, that's no easy job. So I think there is wisdom in not jumping the gun and making huge changes here. I mean, the Fed itself has downgraded the growth projections, which ironically, I mean, maybe I should be proud of this, but after they downgraded, they ended up exactly where our forecast is for Q4 this year, which is 1.7% GDP growth. So if I look at the annual average, that still gives me 2% growth. This talk about impending recession, I think, is far too premature. There is a lot of anxiety because we are looking at some of these indicators that get a lot of press, like the GDP now estimates, which are deeply negative. And is that the new trend? The answer is no, it's not the new trend. There is a lot that is misleading in that number, specifically a lot of physical gold imports that make the net trade drag gigantic in historical context. That will be wiped away when actually the GDP data comes out, because there are adjustments made to that. So the it's true that the risks to both sides of the Fed's mandate have increased. There is both a risk of higher inflation via tariffs, but there is also a risk of weaker growth and more softening in the labor market from all the other things that are happening. And I'll put some of the Doge efforts there first and foremost, because it's not just the employment at the federal level, but the snowballing negative sentiment and just the uncertainty that causes companies and other agencies to freeze hiring for the time being. So the story in the labor market is changing, is much more about the cautious start to the year. And what you're watching is whether that evolves into something worse. Not yet,
Yeah,
but you're not no longer in that sense of, oh, nothing can break this. So my new tagline for the US economy is neither invincible nor broken.
yeah. Yeah, I mean, one of the things that I thought was pretty interesting, because of course this survey data, UMich in particular, but other inflation survey data have popped on this short term, and Chair Powell like specifically addressed that yesterday, and I thought he made a really interesting comment, and I'd appreciate your thoughts on this. He made the comment where someone could reply to a survey being very gloomy and having a down outlook, and then turn around and go buy a new car. And sometimes the behavior doesn't necessarily reflect the survey. And I just wonder sort of how much weight you put on those forward-looking indicators like surveys versus the actual data that's coming in.
Yeah, there's always that discrepancy and a degree of disconnect between the soft and the hard data. I think each has its value, and but funny you mentioned the car example, but today we also got the existing home sales data, which popped higher. So, no doubt that when you look at some of the sentiment indicators, you're like, can the soft landing survive this? Because the moves are dramatic. But precise, I come back to what is the true differentiator in my book. People can be upset, they can be angry, they can be furious, but as long as they are employed, they are more likely to spend money than not, right? So I come back to the difference between a slow growth and a recession really is whether the labor market participates or not. So far, you're still in a narrative of slower hiring. That's still compatible with soft landing. When it turns to firing is when the soft, when suddenly, the soft survey data translates into action. I don't think we are there yet. And I think there is also an element of, today having lived through the inflationary experience of COVID, every single one of us is much more sensitized to anything that can impact inflation, right? Tariffs, we had tariffs in 2018, but if you look at the same survey of inflation expectations, there's barely a nudge higher. You kind of have to squint to see the move. You don't need to squint now. And I think that speaks not so much to the actual impact, but also the sensitivity around any impact.
Hmm.
Because we don't want what happened to happen again, right? Because now we've had an inflation spike and we didn't like it.
Yeah, and that's what made it really interesting that he used the T word again yesterday, transient, with regard to inflation. But I think the part that he was speaking to was specifically around sometimes the tariff shock. And I know
Yeah.
we've talked about this, extensively, is that tariffs aren't inflationary per se. It sort of depends on how they're rolled out. And one of the things that we've talked about is if you're sort of rolling out tariffs in an incremental basis, they could be inflationary. But if it's a one-time price adjustment, then that's a one-time adjustment, and then businesses can decide, whether they want to continue or how. And then there's a lot of, I've been listening to a couple of interviews that talking about there's multiple ways that tariffs are absorbed. They could be absorbed through FX, they could be absorbed through margin compression, they could be absorbed through consumer resilience. Sort of, how are you thinking about these tariffs from your sort of long-term inflation
Mm.
forecast? Still thinking that prices will gradually, the Fed will ultimately coax prices to, or sorry, inflation to that 2% level?
Yes, I mean, it may be also a word there on Fed expectations. So the Fed stuck to 2 cuts for the year. We stuck to 3. We've been a little more dovish, partly because we are a little more constructive on inflation and a little more watchful on the labor market dynamics. But in terms of how you think about tariffs, so they are undoubtedly inflationary on a short-term basis, purely from a mathematical standpoint. The question you can debate how big, how intense is the shock, but even if you have partial transmission, prices move higher. So you have an inflationary impact in the short term. Longer term, you can argue, well, there is demand destruction. So longer term, they could be actually disinflationary or outright deflationary. In any case, mathematically, they run out of the calculation in a year's time. So, you know, Chair Powell is correct when he assigns the transitory effect from that, pure mathematical standpoint. I think absorption can happen a little throughout the supply chain. I think, you know, as much as consumers are so concerned about inflationary impact of tariffs, they're also fairly stretched from a, household wallet size standpoint. It does
Mm-hmm.
not expand to accommodate tariffs. So something has to give. But I also will recognize that it's nearly impossible to truly model this with precision. And I'll just share an anecdote. I'm part of this group of chief economists we have an economic advisory group for the American Bankers Association. So a couple of weeks ago, I was in DC. We were all talking about how do you deal with the tariffs question. And every single person around the room has a different set of assumptions, and not just a different set of assumptions, but even a different philosophy and approach of how to create the assumption. Some people will go and say, well, I'm assuming the average tariff goes from 4 to 8. Other people are like, we refuse to put anything in until it's into actual policy. For us, we try to walk backwards a little bit, just so that we are not actually hostage to every tweet, to every policy announcement and retraction, and ask ourselves what would be a worst case scenario, and then build downward from that what would be a realistic scenario. So we do assume tariffs, we do assume a roughly 50 basis points inflationary hit on a core PCE basis. We made adjustments to our Fed expectations as a result and inflation forecast. So, back in early September, we thought the Fed would cut 5 times this year. Now we say 3, right? It's internally consistent. It may not be the ultimate outcome, but I think you cannot function on a, try to re-estimate a model on a hourly basis. You go crazy.
Yeah, and particularly with April 2nd coming, right?
Exactly.
There's supposed to be an enormous announcement on April 2nd, and it's going to talk about all sorts of other tariffs, additional policy action, and Chair Powell commented on that yesterday, just sort of saying, we just don't know yet, and it won't be 6 to 12 months and before we can start to see it actually in that hard data. So I totally appreciate that. I just want to get back to one thing you talked about with regard to jobs. I think you just bring up such a good point. It's something we've been talking about for a while. People's spending behavior really doesn't change until there is a job loss or until there is some unemployment that impacts a household or a person. And you've talked a little bit about the labor market becoming more in balance. And there's not as many job postings as there was during that peak period in 2021. Um, how are you, so let's bring in the Doge, let's bring in immigration. Do you think that any of that is going to have a dramatic effect on the jobs market? Do you still, like, I was listening to an interview this morning that was talking about an unemployment up at 5% would be actually a significant increase and would really get the Fed's attention and perhaps could get them moving much more quickly. Maybe 5% 20 years ago wasn't that big of a number, but it seems like that the sort of the scale has changed. Is that how you're seeing it, or what are your views on employment?
Well, over time, the scales has certainly changed. In fact, I was looking at this chart I have, and there is something called the NAIRU, a concept that the Fed, just there you have this idea of a neutral rate, that there is a neutral unemployment rate, the non-accelerating inflation rate of unemployment. That changes over time. Some years back, we used to think that's 5.5. The last estimates are 4.2. So when the neutral level is 4.2, if you were to move to 5, you're like, okay, that's a loose labor market or loosening labor market. If you thought it's 5.5, then you're still tight, right? So it's all relative. Now, where do we see the labor market evolving? I do see erosion at the margin, is how I would describe the story. I would say that, to me, the surprise in policy hasn't come via tariffs. We kind of knew that they come, and we knew they'll come in a non-linear and unpredictable fashion. But I think the actions taken by Doge have been more the surprise for me. And I am a little higher on the unemployment rate than the Fed, but I'm not all the way up to 5. Um, so, and then you face a lot of difficulties because, like, on the government employment side, you had the 75,000 people who supposedly took the buyout offer. They are still employed, and in the official payrolls data, they should show up as employed through the end of September. Now, the unemployment rate comes from a different survey where people are asked, are you employed or not? And it's a question mark as whether they will ask, yes, I have a job or not, because they are sitting at home getting paid. So it could be that, the payrolls will show a hit from this arrangement in the October report, but it trickles in the unemployment rate throughout. In any case, I would say you're removing one of the three legs of the employment growth over the last year. Where have we added job? Government, education and healthcare, and leisure and hospitality. Now, the federal government is not a huge player, but you're also making drastic changes relative to, the traditional, very gradual approach. And there is spillover to state and local from what the federal government is doing, plus the funding to programs. So I think that's an area to watch. Plus, again, education, healthcare, there are many things that are in motion now with research funding. So at the very least, you have to assume when people don't know what the future holds, they're not going to go out and hire. So at the very least, everybody's in this mindset of let's wait, so not only 2 months ago, the narrative was very much that the immigration actions would retighten the labor market. Now I think the dynamic is changing in the other direction because of this other policy.
Yeah, interesting. And so wait, so does that mean you're not as concerned about sort of immigration? Is immigration kind of taking a back seat to all that he's doing with Doge and tariffs now?
That had been my view all along. So even it was between tariffs and immigration. And my argument was from an inflation standpoint, I'm much more worried about tariffs as an inflationary force than I am about immigration, partly because immigration is slower moving and already the labor market was coming into balance. You mentioned the job openings having come down. I'm looking at other things. Quits. Nobody's quitting, right? To me,
Yeah,
that's a very telling indicator. I'm looking at hours worked. So people have jobs, but they are not working long hours. To me, that's a story where, what would be the next adjustments to be made? It would be actually like no longer. I don't think you can cut hours anymore because they are already at recessionary levels. So I think the next logical step would have been to cut people.
right.
So that's why I was like, well, when declining labor supply meets declining labor demand, you don't get much of an inflationary impact from immigration. So that was the story all along. Now I feel like the labor demand is threatened by these additional initiatives. So yeah, immigration is happening, and in many ways is, on a medium term basis, I care tremendously
Yeah,
about what happens to immigration. On a 6 months basis, it's not the main
yeah.
concern.
Yeah, interesting. Right. And you mentioned it earlier, and we've seen it in the data, the consumer is becoming more stretched. I just saw a chart in our weekly publication talking about business loans, delinquency rates there are ticking up, credit card delinquency rates, and we measure delinquency rates 90 plus days delinquent. Auto loans up, but the consumer is still certainly much more less levered than they have been 15 years ago. Um, One of the things that we've talked a little bit about is like an actual recession. Yeah, we had a flash recession in 2020, but there seemed to be so much spending that I don't know if it even really counted as a recession. So therefore, we've got like 15 years of economic expansion, really, since 2009, 2008. Is that an okay way to think about it, that ultimately, a slowdown in economic growth is inevitable because economic cycles are real? Is that a reasonable thing to say? What are your views on that?
Uh, I think that opens a bit of a can of worms with the debate around that. I will say so, maybe take it a little shorter term. Whatever slowdown we are experiencing right now, and I think in consumer spending, there has been a step down, also needs to be put into context. I mean, the same way that, in Q4, we were kept being surprised to the upside, and I kept looking at those numbers and like, it can't continue like this. It's just too good to be, like the pace is just too strong. And so in a way, it's healthy to have a pullback. It's a recalibration. Um, one chart that I used for some time was to look at real consumer spending and real personal disposable income, and spending kept up outpacing income. And you say, well, this can only be stretched for that long, right? At some
Right.
point, these two have to come into balance. So, I think it's far too soon to make more of it than what it is. I think from a investor standpoint, there's also this sense of, okay, what happens in the market exacerbates the perception, right? And I would say at the end of last year was like US and nothing else, and now you see capital flows back into Europe because it's also about what happens abroad. And frankly, rarely we talk about Europe, but this green debt deal in Germany is, I like to describe it as the impossible has come to pass, because for years I've been saying, Europe needs to do more. They need to help themselves. Germany in particular is, tying its own hands with the debt deal. And, all the response was the political system can't deliver. And well, now it delivered under a lot of pressure and in an unpleasant way, right? But in effect, something good has come of that.
Yeah.
Um, so, sometimes in money markets, the horizon is very short. I'm an economist. I look like a few months and years out, which is sometimes you try to build a longer term story. Um, I think, the US has a lot of positives, and I do not, I don't think all of this just disappears um, so quickly.
Yeah, it's a good point, and it's worthwhile. Sort of a small little pivot here, but just looking at indebtedness, looking at the debt ceiling, looking at spending. We know that Chair Powell and the FOMC yesterday changed the pace that they're going to let assets roll off their balance sheet, which in a way is a form of monetary policy tightening, right? By
Mm.
reducing liquidity in the system. So what they did was they changed the roll off on their treasury positions from up to 25 billion per month to just 5 billion per month. They left mortgages alone, so mortgages could roll as much as 35 billion a month off, but really only about 15 to 18 billion are rolling off just because mortgage rates are so high, refis are so low, and so really all the Fed is seeing is principal repayments as mortgages amortize. So I guess I'm just interested, in your thoughts on that, Simona, as far as this change to QT. Chair Powell really seemed just dismissive on this as being any big thing. He seemed to sort of just say, yeah, the committee really came around to this idea that they wanted to reduce the pace, they wanted to slow the pace by essentially 20 billion a month. And ultimately just let it sort of run in the background. Now, there's a lot of people that were saying, oh, this has everything to do with the debt ceiling and passing, getting a budget done and spending approvals, the extension of the tax cuts. There's sort of a lot of noise around that. Any views on that?
So I think it does have to do with the debt ceiling. I think, the way I think about it is it's not nothing, it's a risk management step, is how I think about it. Um, we got the government funded, but there is the debt ceiling still to deal with. We've been through this before. You know, I work on the assumption that we'll go through this one again. But, as a policymaker, why take unnecessary risks? And I think the time was building anyways for an adjustment. I have to say it was a little larger of a reduction in the monthly cap than I thought. And, Governor Waller, he descended. Actually, he wanted to keep them unchanged. I think there's no point in reading too much into it other than to say, well, there are this, speaking again about these general conceptual variables, there is also the concept of ample reserves. Like, but we don't know what it is. Right? So you just have like this range, and now you've approached that range, and when you're close to it, why not slow and move carefully? I think there was every reason and I will leave it at that.
Yeah, that's fair. And I would agree. I I'm a believer that the debt ceiling will not be that big of a deal because I think President Trump is going to be able to sort of allay the concerns of those Republicans in the House that are really yelling about spending and say, listen, we're working on it. And so therefore, I think he's going to be able to get it resolved and say, long term, our goal is to lower US debt. And there's all sorts of very unconventional ways that he's looking to do that. And if anybody wants to sort of get into the weeds, you can Google Mar-a-Lago Accord and you'll have an unlimited supply of reading that'll get really wonky on you. My belief is that the Fed recognizes that their balance sheet is huge. It's really a sort of more of a wartime balance sheet, which, it needed to be during that COVID period. That was certainly an extraordinary period. And so now they really want to see that just continue to roll off in the background. They don't want to experience anything like 2019, where they had a real repo dislocation. The other thing to note, and I don't want to get too technical, but repo was trading really on top of the Fed's RRP rate, which right now is at 4.25%, really trading on top of it for the last couple of years until QT really started to have an effect. And now we're trading 7 or 8 basis points above the RRP level, just indicating that there's a little juice. And that the Fed, I think, wants to pay attention to that and wants to pay attention to dealer balance sheets and make sure that they don't get too stressed. Also listening to, interviews about regulation, I think there's a big push on dealers being able to own more treasuries, hold more treasuries, and perhaps some changes in regulation around liquidity coverage ratios, high quality liquid assets. So that'll be something that we really will pay attention to as money market portfolio managers and short-term fixed income portfolio managers. That's a big deal. So yeah, we've gone through a lot, Simona. Have I missed anything? Just looking at my notes here. And of course, I want to encourage the audience, if there's any questions on any of this, I guarantee any question is a good question. So you feel free to drop it in the chat, and we'd love to talk about it. But I do want to talk a little bit about the portfolios. I know we're getting close on time. In the liquidity portfolio, coming into the beginning of the year, when there was this expectation that we were going to potentially be going into liftoff mode, we did start to pull back a little bit of the duration in the liquidity portfolio because we just wanted to be prudent. We wanted to be ready in case the curve really steepened out and gave us some opportunities to enhance the yield in the portfolio. In fact, that changed pretty quickly. And now we do have the view that the next move out of the Fed will be an ease. As Simona said, she's penciled in 3, and we're certainly walking behind that. We think the market is as well right now. So I think patience has been the smart trade there. So we've got the duration right around 35 days right now, and we're opportunistically looking for places to keep that extended and to try to buy the curve. But now with the expectation that the Fed could ease 2 or 3 times this year, it's a little bit harder. So we do have to wait for pockets of opportunities. Additionally, with the debt ceiling coming up, with the Treasury's general account pushing more liquidity into the system. So when the Treasury spends down their general account, that money goes into the banking system in the form of deposits. That means yields come down because there's more deposits in the system. As well as the reduction in Treasury bill issuance, which is very seasonal. It's absolutely what we expect year in, year out, April 15th being tax day. So that's a pay down situation that we're prepared for. We see it. And so we're being pretty tactical right now, waiting for opportunities. In the short term and medium term fund, we continue to extend the duration. Short term's about 9/10 of a year right now. Medium term's around 2 years. Recall that max duration in the short term could be as much as 2 years, and max duration in the medium term could be as much as 3 years. So we do like duration, and we are pushing on those. because we do think Treasury yields will be lower. There has been some talk about all of this indebtedness, repositioning of Treasury issuance. Perhaps the new Treasury Secretary is going to push on issuance into the back end. We have not seen any evidence of that. There was a news story a while ago that's talked about that, but I haven't been able to find it. But every interview I've heard with Scott Bessent of late is that he does not want to change the funding profile of the U.S. Treasury. So we don't anticipate any gyrations there, although we do think the 2-year notes will outperform 5-year notes. 5-year notes outperform 10 in bonds. So it's just we think there's a better opportunity for shorter term rates to come down more quickly than longer term rates, or sorry, more than longer term rates. And I know I'm getting a little technical here, but just sort of describing why we're positioned the way we are in the portfolios. And then lastly, on credit, I would just say we continue to be cautious on credit, even though we've seen some spread widening, and we've used it as an opportunity to buy a little bit here and there, just tactically. We are being very cautious on credit given the uncertainty that's out there and given that credit spreads are just historically tight. They're just very tight. Equity valuations until the most recent sell-off were at all-time highs. And so risk assets just didn't pose a really good opportunity there. So we're being very cautious there, waiting for opportunities that pose better value and will give us a chance to just put more return into the portfolio. So Laura, I know we've got a little bit more time, but we've gone through a lot here. So I just want to take a breath and see if maybe there's questions from the audience or if you're seeing any additional questions.
Yeah, I've had a couple questions come through. So again, I got the chat working now, guys. I do this every time. I never get it set up right. I'm sorry. It's on now. Please use that or the Q&A. So while we see if anyone else has questions for you guys, always so interesting. I did have a couple more that come in on the operational side for CalTrust that I'll address. So the quickest one is someone asked, how often is interest paid? Monthly, quarterly? Our interest is paid monthly on each fund. So at the end of each month, that is when the interest is paid into your accounts or wired out to you if you choose not to automatically reinvest. So that's the easy one. We had someone else ask us, how does CalTrust compare with Camp and Leaf and how do they differ? I can give you some of the high-end comparisons. I will say I only like to speak about things that I do know directly. So anything that's questionable or technical, I'm not going to speak to because that wouldn't be fair. But as far as how we compare to Leif, so there's a few ways that we differ from Leif. One, as I mentioned, we have no limits on how much you can invest in CalTrust. Leif does still have limits. I believe it's a $75 million limit currently, and then they'll allow you to have bond accounts separately, potentially. So they do have a limit on how much you can invest. They also have limits on how many transactions you can do. I believe you're still limited to 10 transactions a month with Leif, and they have to be in certain increments. I think it might be increments of like $1,000 or something. So those are some differences. Also, if you are withdrawing more than $10 million from Leaf, you have to give them additional notification than their standard notification period. I believe that requires 24 hours notification. Like I mentioned, we pay our interest out quarter or monthly. Leaf pays theirs quarterly, so that's another difference. Another really key difference, though, is how our funds are structured. We're structured very differently than Leif. So, like Liliana mentioned, our WAM currently, I just had the February 28th one in front of me. The number I'm staring at is 42 days. I believe Leif, the number I saw today, was out over close to 300 days, 280 or something. So the fund itself is actually structured quite differently, as Leif is just a portion of the PMIA, which is a much bigger state fund, versus being an actual independent fund on its own. So those are some of the key differences between us and Leif. Between us and CAMP, what I can say is our liquidity fund and CAMP's main fund, structurally, they're structured pretty much the same. They're both like 2A7 lookalike funds. They're very similarly operated as far as the funds themselves. The differences you see between CalTrust and CAMP are more on the operational side. We have a later cutoff time than CAMP does. I'm not sure if theirs is 10 or 11, but ours is noon for liquidity funds. So there is a difference in the cutoff time. Um, we offer 3 funds. So whereas our liquidity fund and their main fund is the same, we then offer our short and medium term fund that they don't offer. And then they do offer term, which is like their CD fund. So there's some different types of offerings in addition once you go past those stable NAV funds. The other big differences I would say are trying to start oversight. So CalTrust RFPs all of our service providers. CAMP typically has not done RFPs for their service providers. Additionally, we're independent as far as our administration. So as a CEO, I am a CalTrust employee. Our employees are CalTrust employees. We are independent JPA employees, whereas the administration at CAMP is actually employees of the bank that manages them. So they don't have that independent management. Their management are bank employees who are part of the bank does investment management. And then our transparency differs. So, like I said, with us, we have all of our holdings are available basically in real time, at least same day, for our shareholders to see through the portal. CAMP does not provide that same level of information on a daily basis for their holdings, and so there are transparency differences between us. And the last thing I'll say is CalTrust staff, our direct staff who works with you, myself, my team, we all are from a local government background. So the team you work with on a day-to-day basis, as far as the account management and understanding, we all actually, I think everyone on my team has been in the local government space for at least 15 years. I'm in my 23rd year of working with local government. So that's kind of one key thing about us as well as we've all worked in the government space and all kind of understand and know our shareholders as far as the operational side. So those are what I would say are kind of the key differences. I'll ask Will if you want to expand at all on the difference with the lay funds and how they're structured. And if not, that's fine. I know we're running up on time, but
No, the only thing I would say is when you are doing comparisons, I would just make sure that you look at the attributes as Laura described. The duration of LAIF is very different than the liquidity pools, like CAMP and CalTrust liquidity pool. And LAIF is probably more comparable to like our short-term fund from a risk standpoint. And I know there's all sorts of redemption constraints and subscription constraints on Lathe, and they do a nice job of sort of laddering the portfolio. But I just would encourage folks to make sure you're comparing the attributes of the fund. And then I would also encourage folks when you're comparing liquidity vehicles to really stretch the time that you make the comparison. So look at that daily yield over the course of a year. I really encourage people to look at it over the course of a year because their cash flows can impact a fund's yield. And so you just don't want to do a 7-day yield comparison when one fund's had a good 7 days and the other fund had a bad 7 days. I think looking at it over a longer period of time is really beneficial to your analysis.
that's a great point. Last question that just came in is, does each agency receive an account manager with CalTrust? So you have your key points of contact when you have an account with CalTrust. So Nicole Zajic is our key point of contact for shareholder servicing. So she would be your day-to-day kind of go-to person with any questions you had on your account servicing. And then myself and Todd Winslow are also available at any point. And so between the 3 of us, you'd have Nicole as kind of your key daily point of contact, and then we are directly available to you as well. I think everyone has my cell phone number. It's the world's, yeah, it's out there. It's not a mystery. But yeah, we're always available to you. So I don't see any more questions coming in. We always enjoy doing these. I hope everyone didn't get too tired of my gravelly allergy voice while I was talking, but thank you so much to everyone for spending a portion of your morning with us. We will send out a copy of the presentation that I showed this morning so you have all that information. If you have any follow-up questions, please don't hesitate to reach out to me directly, Laura at caltrust.org, LAURA. Can't get much simpler than that. Never even tried to put my last name in there because it just wouldn't work for anybody to try to figure out, but I'm always available to you. And our team is. If you have any other follow-up questions you think of, even for Will or Simona, let us know. We are happy to continue conversations at any point, any time. Will and Simona, thank you so much for your time this morning. It's always so great to hear from you both. And I have my whole page of notes that I wrote down. I learned so much. So, everyone, have a wonderful day. Happy first day of spring. I hope everyone is having less problems with allergies than I am on the first day of spring and has a wonderful day. Thanks so much, everyone. Bye.
Thanks, Laura. Thanks, everybody. See you later.